Before we start this video, do like and subscribe to our channel and not miss on any updates.
Friends, today we are going to learn about Accounting Standard 12 on government grants. Let's first understand what that word means, government, and then the other word is grant. Government in this context refers to state government, central government, any international development agency like something like World Bank or US Aid or UK Aid. Then you may also have these cantonments or local administration bodies. So all these come under that broad definition of government. And the other word is grant. So grant is basically a benefit given to an enterprise. It's not equity investment or debt investment. So basically grant is more like an amount given saying, hey, so this is for your benefit, so maybe you suffered something in the past for which we are giving you benefit, or you have to do something in the future for which we are giving you benefit, or you are doing some good work for which we want to encourage you by giving this kind of money. So basically grant has alternative names like subsidies, bounties, or you can also have some sort of incentives, cash incentives. So all those come under the broad meaning of grant. Now, what is this accounting standard going to talk about? How an enterprise should recognize and account the government grants, and those related disclosures will be discussed as a part of this accounting standard. So, let's take an example. There is a company which wants to set up its factory, say, in Arunachal Pradesh. Now, the conditions are quite difficult, for say setting up factory. It's a hilly area, and I still remember the cement bags were almost 25% more compared to the cement prices in a place like Delhi. So, basically these are more challenging terrains to operate business in, but government wants business to happen even in those areas, and say government gives an incentive to the company saying, hey, if your project cost is 100 crores, we will give you an incentive of 20% of your overall project cost. So out of 100 crores, first you spend 100 crores and then you will get 20 crores back from government as an incentive. Now this kind of a subsidy or an incentive what government gives is an example for government grant. Now a company which is actually setting up this factory needs to find a way to account for this 20 crores of government grant, right? So how should they account for it? We will learn as a part of this accounting standard. Similarly, say there is a company which wants to set up a cold storage facility. Now, cold storage facility probably to have fruits and vegetables, in that cold storage, and in off season to release them into the market and things like that. So the company wants to set up a cold storage facility. The cost for that cold storage, say, is 1 crore. Government says, yes, so it takes time for businesses like this to be viable. So we will encourage people to come into this business by giving an incentive or a subsidy for that particular asset. So for that cold storage asset, if your cost is 1 crore, we will give you about 50 lakhs as subsidy on that particular machinery. So it's an asset specific subsidy what government is giving, unlike the subsidy in case of that plant or that factory in Arunachal Pradesh where it was on the entire project cost. So here it's not on the entire project cost, it's more specific to say there is one machine which is used for air conditioning. On that machine government says, okay, so we will give like 50% subsidy or 75% subsidy. So in such cases also there can be a case of government grant, and we will learn as to how accounting has to be done. Take the example of a fertilizer company. Say the production cost for a fertilizer is 100 rupees and selling price of that company to the farmers say is 120 rupees, 20% margin, and they want to sell it at 120 rupees. Government can come in and say, we will ask you to continue your margin of 20% on cost, but what we will do is that original cost of 100 what you have, we will give you some money which will reduce that cost. So basically your cost will get recovered. So your cost of 100, if it becomes 90, imagine some 10 rupees of subsidy government is giving and your cost becomes 90, then what will happen? On 90 you will add a 20% margin. So instead of 120 rupees as a selling price for the farmer, maybe the selling price might be 108 rupees. So like this, there can be something like an input subsidy that a fertilizer company can get. Such subsidies are also covered by this accounting standard on government grants. Similarly, government, instead of giving assets or instead of giving money, government can say, hey, we will give you land free of cost. That is also a form of benefit what government is giving to encourage a specific business. So in such cases, how to deal with it, that also we will learn as a part of this standard. So friends, it's a very interesting standard and you have a broad sense of what kind of things get covered in this particular standard. And now let us go into more details. So let's understand what is excluded from the scope of the standard. If a company is basically dealing with the government in its normal trading activities, something like it buys from government or it sells to government, that is not covered within the purview of accounting standard 12. Similarly, tax holidays and tax exemptions that company receives under section 10, section 80, those are also outside the purview of accounting standard 12. Government participation as equity holder. So basically in your company, if government is an equity investor, that is also outside the discussion of this particular accounting standard. Also, sales tax exemption, basically that is neither a cash or it's neither an incentive in cash or nor an incentive in kind. So sales tax exemption is also not covered by accounting standard 12. So we will now talk about when to recognize a government grant. So whatever be the kind of grant, so we spoke about a lot of examples, whatever be the kind of grant, when to recognize a government grant. So friends, first thing first, is government grant a benefit for the company or is it a loss to the company? Obviously a benefit for the company, right? So if it is a benefit for the company, there are points around prudence what we have to remember. So any benefit can be recognized only when there is reasonable certainty that we will actually get that benefit. So when a company wants to recognize government grant, there are two broad conditions that you have to remember. One, that grant should be sanctioned, right? So it's not obvious that just because you're doing that business, you'll automatically be entitled to that grant. You have to make an application, government has to approve that application. So there is a process for it. So government has to accept that. So that confirmation letter or that acceptance or award of grant is one parameter which has to be checked. What happens because of this is, once government accepts that grant to specific person, like say government grants that accept that grant and says you are entitled to that government grant and we are approving it, you will have that amount as an amount which can be collected. So that collectability of that amount can be ensured. So to ensure collectability, you require government to sanction that or approve your specific file. So that is the first condition what you have to check. The second thing is, conditions relating to the grant, the entity should have the capability to meet. So it should have already met or it should have the capability to meet in the future. So no grant will come just like that. Everything will have conditions attached to it, right? So if government is giving you an incentive, government says, hey, you are doing this work and you will continue to do this, and for so and so we are giving you some benefit. So there is money being given by one person to the other person, so there is an expectation attached to it. We should have met that expectation or we should have the capability to meet that expectation. So friends, basically what I am talking about is, conditions attached to that government grant should have been met or entity should have the capability to meet. Let us now see in a precise manner what this point is all about. So when to recognize government grants? A company can recognize receipt of government grants on satisfying the following conditions. Conditions for receipt of government grants should be fulfilled. So those conditions, if they are already fulfilled, that's fine. If they are not fulfilled, there should be capability. So basically ability and willingness. So intention and willingness on the part of entity, ability and willingness on the part of entity to fulfill those conditions. And the second thing is, grants are certain to be received. So when will grants become certain? Only when government awards or allots that particular grant, those grants become certain. So those two conditions must be met. Friends, in this point I said the entity or the company must have the ability and willingness to actually meet those conditions. Sometimes it may so happen that government awards a grant that basically government would have already given you money. Say government transferred some 1 crore to this particular company saying for so and so purpose the amount is transferred. Just because amount is transferred as government grant, don't think it is a conclusive evidence that government grant can be recorded as income. Listen carefully. Even if government has given grant to us, if we do not have the ability or willingness to meet the conditions attached, well, the government grant may go back. So considering that, if there are questions about our capability and intention to meet the conditions, government grant should not be recognized as income. So basically government grant should not be recognized at all. So you can't call it a grant. You can probably say I received money, that money has to be given back. So you can maximum say that. You can't really say it is a grant unless these two conditions are met. So this is like really important. Friends, another point is, whenever the company receives government grant for any past event which is more like say earthquake or some floods have occurred, and as a compensation a company is receiving government grants. So there is no future condition that has to be met. Something has happened in the past, in a compensatory manner amount is being received by this company in the form of government grant. If there are calamities, earthquakes, etc., what did we understand in Accounting Standard 5? These should be shown as extraordinary items. So if these are shown as extraordinary items, even the compensation what is received in relation to those extraordinary items should be disclosed under extraordinary items only. So it's just a P&L disclosure point, and a note can be given in the notes to accounts indicating that so and so is received as a compensation for the loss suffered due to earthquake, etc. Friends, if there is a road that is laid by government in front of your home, imagine there are 10 houses in your street, can that road be called as a grant given by government to you? Think about it. No. You can't even say 1/10 of the cost of road is a grant to you. Why? You do not have control on that road, in the sense you cannot say I will do whatever I want on the road. You just have access, or you just have right from government to you kind of travel on the road and come back, that's all. So you don't own that road, or you don't have any control on that particular road. So you just have usage right on that and nothing more. So friends, considering that cost you cannot say has to be like, there are 10 houses and this road is only for these 10 houses, by 10 is a grant that is attributable to me. No, you can't say that. Similarly, if you are purchasing power, electricity from electricity department, can you say that it is a grant what you are getting from government? No, that is not a grant what you are getting from government. You are purchasing a commodity from government and you are not getting any grant from government, even though you might be paying only a fraction of the cost what government would have incurred. Because you know what, government, if it spends 4 rupees to purchase 1 unit, maybe it charges from the customers, residential customers, etc., only 3 rupees or 2 rupees or something like that. So even for a company, maybe the government for any reason is actually giving you at some concessional price. You can't say there is a grant factor in it. So these things are purely commercial transactions of purchase or sale, and these are not to be considered as government grant. Broadly, there are 2 approaches for these government grants. The first approach is called as capital approach, and the second one is called as revenue approach. What is the meaning of capital approach? Under this approach, the government grant amount will be considered as a capital receipt by the entity. So it is considered as an amount which is something like received towards fixed assets, or it is of such nature that you cannot treat it as a P&L item generally. It is something which is treated more like a capital receipt. The other theory what is propounded is that the government grants are more in the nature of revenue. These are to be credited to P&L. So these are viewed more as revenue items than capital items. Now, which of these two theories is correct? Both are correct. So there are certain cases where we do accounting considering capital approach, and there are certain cases where we do accounting using revenue approach or income approach. So we call it as income approach or revenue approach, both are fine. So we will now discuss about 4 broad situations what we can envisage under this accounting standard and what kind of accounting treatment is recommended by accounting standard 12. First one, grants related to depreciable assets. Then grants related to non-depreciable assets. Then grants related to revenue, and finally grants towards promoters' contribution. So let's talk about the first scenario, grants received for depreciable fixed assets. So first thing, these are specific identified assets, because if they are not specific assets, if the grant is given for business as a whole, etc., it goes into the last category called promoters' contribution. Okay, so here these grants are for specific identifiable fixed assets. So if these are for, say, there is a machinery in the entire company, that machine's cost is 1 crore and government says 30% of the cost of machine we will give you as grant. So 30% of 1 crore, 30 lakhs is the grant what government is ready to give, right? So government first check whether government has sanctioned it to this particular entity, right? And second, whether entity has the ability and willingness to actually fulfill those conditions which are attached to that particular grant, right? So those conditions are made, everything is taken care, government has awarded, fantastic. Now 30 lakhs of sanction has come. Whether or not amount has come, sanction has come. So accrual concept. So you are not really waiting for amount to come. Amount could have come, or maybe amount has not come yet, only sanction has come. Still now we want to talk about recognition of that particular government grant. It is for a specific depreciable fixed asset. Now what is the treatment for it? The accounting standard says option 1, you can reduce that 30 lakhs from the cost of asset and you can consider depreciation only on the 70 lakhs amount, that is 1 crore minus 30 lakhs, only on 70 lakhs you depreciate, don't depreciate entire 1 crore. So what is this approach called? Reduced cost approach. Under reduced cost approach, the amount of grant is reduced from the gross value of asset and only the net amount now will be depreciated over the balance useful life. So if 1 crore is the asset cost, 30 lakhs is the grant. So what is the amount of the reduced cost of asset now? 70 lakhs is the reduced cost of asset, and the 70 lakhs will be depreciated over the balance useful life. Say balance useful life is 10 years. Over 10 years, assume salvage value to be 0. 10 years is the period over which 70 lakhs will be depreciated. So every year P&L will be debited in the category of depreciation by an amount of 7 lakhs. So that is what is the reduced cost approach. Now the other approach what can be used is deferred income approach. What is deferred income approach? Under this approach the standard says asset is at 1 crore, life is 10 years, depreciate the asset at the gross value only and let the entire 1 crore be written off over 10 years time. Say straight line method we are following. For convenience sake I am taking straight line method. The company can follow WDV also. So straight line method we are following. Every year 10 lakhs, 10 lakhs, 10 lakhs is debited to P&L under the category of depreciation, right? So debit to P&L is 10 lakhs. What is the amount of grant? 30 lakhs. This 30 lakhs which is a benefit will now be credited to P&L in the ratio of depreciation. So over how many years? Well, the same 10 years period, this amount of 30 lakhs grant will be credited to P&L in the ratio of depreciation. So listen carefully friends, when that grant of 30 lakhs is received, what will we do in such case? We will receive that grant and we will put that entire amount under a category called as deferred government grant, and slowly that deferred government grant will be going into P&L account year by year. So out of 30 lakhs, okay, first year you will credit 3 lakhs to P&L. Now 10 lakhs was debited in the name of depreciation, 3 lakhs will be credited to P&L in the name of government grant income. Basically that is a government grant income, so 3 lakhs will be credited to P&L. If you see the net impact, what is the net impact on P&L? 10 lakhs debit, 3 lakhs credit, net impact is 7 lakhs only, right? So even under reduced cost approach, what was the net impact? Same 7 lakhs. So whether it is a reduced cost approach or a deferred income approach, net impact on the profitability is same. Just that the way expenses look and income look, that will be different, but the net impact is same. Now imagine, government grant is making the asset cost 0. Government grant is making the asset cost 0, or maybe hypothetically government gave you more grant than actual cost. In such cases, accounting standard says still the asset should be shown at nominal value. So you cannot say government gave you for entire 1 crore a grant, so we will make 1 crore minus 1 crore 0 as the cost of asset. No. So the standard says still show it at a nominal value, 1 rupee or something like that, so that that asset will at least be seen in the books of account. So why is the standard asking us to show it at least at a nominal value? I mean, if you do these, when you use these accounting packages and accounting softwares, you will realize when the amount is 0, that item will not be seen in the assets. Please understand. If the amount is 0, it disappears from the asset. So you don't have to worry about it at all, right? But here is an asset, it's there in the business, just that its book value is 0 because government has given a grant for the entire amount. So in such cases again, we have to show that asset at a nominal value, say 1 rupee or 10 rupees or 100 rupees, it's some nominal value that an asset has to be carried in the books of accounts. So imagine in that deferred income approach, the depreciation is not on straight line basis, it is on WDV basis. Say, just for convenience sake, first year depreciation is some 10 lakhs, second year is 6 lakhs, third year is 4 lakhs, and so on. So 10 is to 6 is to 4 is to, and so on, something like that. So that is the ratio of depreciation over time. In that ratio, the amount of government grant has to be transferred to P&L. So the accounting standard clearly says this amount of government grant, 2 questions you have to ask. Over how many years should it be credited to P&L? Over the life of asset. That is the answer. Second question, in what proportion in that period, in what proportion year to year, in the ratio of depreciation that is debited to P&L in that period, you will have to credit this government grant. So basically, when you do a net off between depreciation and government grant, we saw that this net impact should be comparable to reduced cost approach based calculation. So that is what the accounting standard talks about. Alright, so this is about deferred income approach and reduced cost approach. These are the 2 approaches what we use for what? For government grant relating to a specific depreciable capital asset. Ultimately, unless we see all these things from accounting entries and balance sheet P&L standpoint, these things will not sit in our head properly, right? So first case of reduced cost approach, let us look at the accounting entries. Assets cost is 1 crore, right? So what is the entry for purchase of asset at 1 crore? An asset is coming in, fixed asset is coming in, machinery is coming in. So that machinery account, fixed asset debited to, if the company has paid 1 crore rupees, to cash or bank 1 crore. If that amount is not yet paid, to creditor for fixed asset 1 crore. So that is the entry for purchase of that particular asset. Fantastic. Then, when should this entry be passed? This entry should be passed when that risk and reward in that asset is transferred to this particular entity. So when that asset is acquired, risk and reward is transferred, this entry should be passed. With what value? 1 crore, we saw that. So this 1 crore ideally includes all the incidental costs and adjustments for taxes and all based on the principles of accounting standard 10. Fantastic, done. So that's about the first journal entry. Right, come to the next one. The next entry is for that 30 lakhs of government grant. Is it compulsory that you should receive government grant on the day on which you purchase that asset? Not necessary. Maybe you will purchase the asset, with those invoices you will apply to government. After 1 month, 2 months, 6 months, you don't know when, based on your luck and horoscope, you will get the award from government. So you cannot really say as to when you will get it. It kind of comes in due course. So considering that, when the two conditions what we spoke about for government grant are met, what are the two conditions? Once again, this is like super important. So what are the two conditions you have to check for government grant recognition? The grant should be receivable, that is, there should be certainty regarding the receipt of grant. So that certainty will come when government awards that grant to us. And second, entity should have the ability and willingness to meet the conditions attached to those government grants. So when those two conditions are met, then you can say, acha, now we are entitled to recognize this government grant as a grant. So technically, now say you got money, you got 30 lakh rupees. Then what is the entry? Bank account debited 30 lakh rupees to what? To government grant 30 lakh rupees. So to government grant 30 lakh rupees. So this is the entry what you are passing. Imagine government grant is not yet received. It is still receivable. Then what is the entry you will pass? Credit side will not change, only the debit side. So instead of writing cash or bank account debited 30 lakhs, what would you say here? You would say government grant receivable debited 30 lakhs to government grant 30 lakhs, right? So this is the entry for government grant recognition, right? Now let's move to the next one. After you pass this entry, the discussion is what should you do with the government grant, that account called government grant. See, if there is something called government grant receivable, what will happen to that? Amount will be received in due course, that will be closed in due course. How? Cash or bank account debited to government grant receivable, that 30 lakhs will be received and that government grant receivable will be closed. Now the discussion is only about that government grant account. What should be done with that government grant account? The standard says you have to net it off against the asset value if the entity chooses reduced cost approach. So if this is a specific depreciable fixed asset and if the entity chooses reduced cost approach, then the entry what we will pass is, earlier we said machinery account debited to cash or bank for 1 crore. Now that machine account should come down to the extent of 30 lakhs. This government grant will be debited. So basically what is the entry? Government grant account debited 30 lakhs to machinery fixed asset 30 lakhs. That's all. So basically at this stage, if you look at the balance sheet, if you just drop the asset account and see if you have to suddenly push this asset closing balance into balance sheet, what is the balance at this stage before any depreciation? 70 lakhs, right? So the asset account has a net amount of 70 lakhs. This 70 lakhs, listen carefully, this 70 lakhs of revised cost of asset gradually, slowly, 7 lakhs, 7 lakhs, 7 lakhs, 7 lakhs will go into P&L account in the form of depreciation, assuming it to be straight line basis over 10 years. Now, if it is WDV method, maybe based on the WDV rate, you will transfer year on year that amount of asset to P&L. But ultimately, you will ensure that most part of the asset is written off over the life of that particular asset. Now, let's come to deferred income approach. What kind of journal entries you think we have to pass for deferred income approach? First, asset is acquired. The entry is asset, fixed asset account debited, that machinery account debited to cash or bank, 1 crore. Will that entry change whether it is reduced cost or deferred income? No, that entry is same. Then 30 lakhs of government grant is awarded by government and we want to recognize that. When to recognize that entry? We already spoke about it. And how to pass that entry? We already spoke about it under reduced cost approach. Same entry you will have to that extent. Now, the point what you have to remember here is there is something called as government grant, what we wrote, in case of the reduced cost approach. Here we will say bank account or government grant receivable account debited to deferred government grant account. Instead of just writing government grant, we will write that as deferred government grant account. That's all. So you are just adding or prefixing that word deferred. Okay. So the amount is 30 lakhs. Great. After that, move to the next one. At the end of the first year, say the company is following straight line basis and the company wants to provide depreciation. Depreciation entry for fixed asset. That is something known to us. If you are following net basis, then it is something like the depreciation account debited to fixed asset, but most companies don't follow net basis of showing this fixed asset account. They will show only gross basis. So then what will happen? There will be a provision for depreciation which will be created, right? So depreciation account debited to provision for depreciation account, say for 10 lakhs, 10 lakhs. That is what will happen at the end of first year. Now from deferred government grant, you will transfer proportionately that amount into the P&L account. So what will happen? If the depreciation ratio, expected depreciation ratio for the next 10 years is 10 lakhs is to 10 lakhs is to 10 lakhs and so on. So basically 1 is to 1 is to 1 is to 1 is to 1, so on. So if it is an equal ratio, then even that government grant as well will be credited to P&L in equal ratio. So in such case, out of 30 lakhs, 3 lakhs will be transferred into P&L account. So what is the entry for it? Right now, we credited deferred government grant with 30 lakhs. Now we will debit deferred government grant with 3 lakhs and credit P&L to the extent of that 3 lakhs. So what is the entry we will pass? Deferred government grant account debited 3 lakhs to P&L 3 lakhs. So in P&L account effectively you are giving a credit impact to the extent of 3 lakhs. So that is what is happening. So if you look at the net impact, depreciation of 10 lakhs got debited to P&L and this deferred government grant, whatever went into P&L is to the extent of 3 lakhs. So 10 lakhs debited, 3 lakhs credited. Net impact if you see 10 minus 3 again 7 lakhs is the net impact what is hitting the P&L.